Now joining me for a closer look at the day's markets action is Chantal Marx from FNB Wealth and Investments. Chantal, thanks so much for your time this afternoon. So President Donald Trump making somewhat of a U-turn on tariffs, hitting pause for 90 days and making room for negotiations, right? That spurring a rally. We are seeing green screens across the board. So clearly some calm returning to markets, but we can never be too sure because things just change at a snap of a finger.
Absolutely, and that's why I won't term it as calm at all. It's kind of a scary kind of bear market feeling rally that we are experiencing at the moment. I don't want to say it's a dead cat bounce, but it certainly feels that way, especially if you look at what happened in the US market last night. The absolute scale of the moves were just so huge. And to put it into context, the last time the S&P 500 rallied to that extent was in 2008, and the S&P 500 was still down 28% to its lows from that point. For the Nasdaq, it was 2001, just after the dot-com bubble popping, and there was still 57% downside for that index. So I would caution to get too optimistic because of this delay. What the delay does do is it gives other parties an opportunity to negotiate. It gives you some time, but I think it's also going to give us 90 days of uncertainty and volatility was guaranteed.
So we're most likely going to see, markets yo-yoing across the board for the next 90 days as volatility remains the name of the game. Let's get into some company news. Life Healthcare out with an update today. Metrics seem positive on an operational front, but there will be pressure on profit because of that disposal that will be coming through within this period. Just your general analysis on that update, Chantal.
Yeah, so I thought that the underlying result looked really good. The guidance certainly is quite positive. It's always great to see that a company of this nature is able to grow its revenue in the high single digits, and that translates into a meaningful improvement in profitability. I think when we look at the kind of loss on a non-normalized level, so just on a reported basis, that really does seem quite technical to me. It relates to contingent payments that they had to make to the previous owners of Life Molecular Imaging. So I think just part of that disposal, ultimately that disposal will be quite beneficial to shareholders from a cash returns perspective. I think the only question mark now is after they've sold AMG and after they've sold Life Molecular Imaging, where is the growth going to come from?
Yeah, definitely. And moving over into the mining sector, how concerned are you about, the deal between Anglo and Peabody? I mean, it seems like there's some uncertainty there, and that might, push back their restructuring plans.
Yes, I mean, it's one of the promises that Anglo-American made to shareholders when they were kind of fighting off that BHP bid. They need to get rid of steelmaking coal. They need to do something with the diamonds business, and they need to unbundle Anglo-American Platinum. So Anglo-American Platinum, that is progressing quite well. We still don't know what's going to happen with De Beers, and then you've got this Peabody situation that seems to have the possibility of delaying the steelmaking coal divestment as well. So I think given the uncertainty around what they're going to do with diamonds, I won't be too concerned from an investment case perspective right now. I think they will be able to find someone to take the business off their hands, whether it be Peabody or someone else, perhaps another miner where that specific sort of business fits a little bit better into their portfolio.
And do you think they're going to hold on to De Beers for longer, Chantal, considering that, the diamond market is really under pressure at this point, and I guess they can't get it off their hands at a reasonable price?
Yeah, I mean, so what they did with Anglo-American Platinum with the unbundling is that you already had a listed entity. They were able to sell some of those shares in the market and generate cash in that way. They're going to unbundle a fair chunk of it, and then they're going to retain 19.9%, I think, for a certain period of time, just to not result in too much volatility in that share price once it lists now, or once that unbundling actually takes place. Now, with De Beers, it's kind of an awkward scenario because they seem to be struggling to find a buyer. they'll have to list the company and then unbundle it to shareholders. And they're going to have to list the company and unbundle it to shareholders where diamond prices are so low and that business is facing so much strain. And because it's not listed already, it's just not as easy as it was with the Anglo-American platinum story, and it's certainly going to be quite difficult for them to realize any value from it.
And I ask myself if there's actually appetite for, you know, a diamond company listing on the JSE or anywhere else. But it looks like there is appetite for PGM stocks. Chantal, I noticed that 91 has purchased shares in Northam Platinum. The PGM counters have been experiencing, you know, a downturn for quite some time. I think for about close to 2 years on the back of the depressed prices. But I don't know, it seems like there is some sort of change in sentiment, improvement in sentiment. Is this off the back of, you know, PGMs not being included in Trump's tariffs?
So I think it certainly helps the investment case that it's not included. I think if you look at what market analysts have been saying over the last 6 months to 8 months is that we don't actually understand why platinum group metal prices aren't increasing. And one of the reasons why is because the PGM market is actually in deficit. So there isn't enough to fulfill demand going forward. So what the theory was around that was that a lot of these big automakers and some of the other kind of suppliers or kind of middlemen within that supply chain was actually hoarding quite a bit of stock, and that it resulted in demand at a mine level being a little bit depressed, and the price also being depressed as a result. But we've been questioning for some time when it's going to kick up because of that deficit, because that deficit has persisted. Most of these miners have actually pulled back production now. And yeah, I mean, this could be the start of something really good for the PGM sector, but I've been hurt before. So I would still be quite cautious at this point.
So a wait and see approach. All right, let's just hit pause on the conversation. Before we get to your stock pick, let's reflect on some counters that have found favor with your industry peers.
So the story here is that it's come off 15% when a market's come off 7%. Not everything they hold has behaved like the financial sector or the resources sector in the last while. You think of some of the biggest holdings in terms of process and some of the globals. So I would argue the AUM has probably not come off nearly as much as the share price. And if you believe that this too shall pass, maybe, in the next 6 months or the next year, we'll see equity markets recovering nicely, then this thing for me at $33 looks very, very cheap. I know, other people, maybe Roy feels that, the institutional guys are going to battle to sort of grow their AUM, but they don't really need to grow awfully much. It's just ridiculously cheap right now. And I don't think that, the current level of markets are necessarily reflective of where we're likely to be, a year from now. So it's a little bit of a gamble because markets have been volatile, but I think at $33, given the fact that all the earnings basically just flow straight through, I think you've got a lot of compensation for the bet.
So AB InBev is a big leader in that beer market. I mean, the total profit pool in the beer market is over $100 billion. They have more than 500 global and local brands as well, dominant positions in many territories, both developed markets and emerging markets. I think the big thing about this one is I think they're immune to tariffs because beer is local. Yeah. People identify with their local brand, and it's generally brewed within, I don't know, a 5-10 kilometer radius, give or take. So they're nicely hedged. So they're still in the US, they're in emerging markets. If the dollar strengthens, the US does well. If the dollar weakens, the EM comes through. So I think if you're looking for a place to hide, a little bit of rand hedge, give or take, this one is one that's attractively priced and has a good earnings growth momentum behind it.
So, Graham going with Coronation Fund Managers and Roy going with AB InBev. Your analysis on those counters, Chantal?
Yes, so I agree with Graham that Coronation looks super cheap at the moment. Coronation also has the additional kicker of paying out 100% of its earnings to shareholders, so you get a really attractive dividend yield as well. I think that they are in for a little bit of pain from an earnings perspective due to kind of pressure on the markets that we're seeing currently, and the likelihood that that could persist for a few months probably sours the investment case near term a little bit. But I think if you're a long-term investor and you're willing to close your eyes for the next 3 to 6 months, then Coronation seems like a good idea to me. And AB InBev is also a stock that I really like at the moment. I think Roy's point is very well made around its immunity towards tariffs. Earnings momentum is extremely strong. They're bringing down debt quite nicely. And even though beer as a category isn't a growth category from a drinks perspective, they are in beer growth markets with their emerging market footprint, and they're extremely well diversified. So yes, thumbs up to both of those stock picks, but close your eyes on Coronation for 6 months.
All right, thumbs up to both those stock picks, but that not being your stock pick, what are you hanging your hat on today?
So my stock pick is the JSE, the company. I think that market volatility is really positive from a volumes perspective. You will see a lot of trading, and that will be very positive for their equity markets business. I also think that they could actually benefit from on the data side, because I do think that because of things shifting as rapidly as they do, demand for some of their data services may pick up as well. The only kind of negative area for me would be that you're probably going to see a lack of primary activity. I think the JSE is quite used to that, though. So perhaps that's something that will dampen the investment case somewhat. But the stock doesn't look expensive relative to its earnings outlook. And yeah, I mean, I think when you're looking for something defensive in a market like this, the JSE is a natural choice.
Chantal, thanks so much for your time and taking us through trade at midday. That was Chantal Marx from FNB Wealth and Investments.